What's going on, Z Community Cuties? It's your boy Azizz Finance, and welcome back to the Personal Finance in Canada show, also known as the PFC show. Whether you've been listening to our podcast for a while now, or this is your first time, be sure that you're either following or subscribe to the pod, and share this with somebody who you think will also get value from this podcast as well. Now, without further ado, let's get this party started and dive into the episode. By listening to the PFC show, the Personal Finance in Canada show with Azizz Finance, you acknowledge and agree that me, Azizz Finance, assume no responsibility for any financial decision or decisions that you make, as it is ultimately your finances and you are the only controller of your own decisions. I am a random person on the internet and not a financial professional, so please consult with one being a financial professional before making any financial-based decision, because anything that you hear on this podcast, overall, each and every single episode, is just a sharing of my experience and are not suggestions whatsoever, regardless of the types of language or words that I use within these episodes. Again, by listening to this podcast, you acknowledge that I assume no responsibility for any decisions that you make regarding your finances. Alright, so in today's episode, we're going to talk about, hands down, one of my favorite things when it comes down to the investing or the financial space, options and option strategies. Today's episode, we're going to be doing a deeper dive on covered calls, and if you guys have any questions, as always, reach out. I'm more than happy to kind of help or, provide further clarification if needed. Nonetheless, covered calls are one of the first option strategies that I personally came across, and, this is exactly why we're discussing this first. Now, if you're here without any knowledge on stocks in the first place, I suggest that you first master the overall stock market before even thinking about getting into options. Because even though your favorite influencer might swear by these and, making tons of thousands of, if not millions of dollars from options, you're not ready. Because options are literally stocks on every single drug on the planet and simultaneously. But a brief overview before, start going through all of our past episodes to learn as much as possible about stocks. Options are contracts that represent 100 shares of stock. This means one contract equals 100 shares. 5 contracts represent 500 shares, and then 10 contracts are 1,000 shares. And when it comes down to the options world, there are really two people at both ends of these contracts, being the buyer and the seller. Buyers of these contracts are people who will basically be calling the shots at any time possible. Obviously this will depend on the type of options contract that you do, whether it's a call or a put, but nonetheless, the power is all within the options buyer. The other person, on the other hand, is the option seller, and they are always being forced to do something that is holding their end of the deal. This means when the buyer decides to snap their fingers, they're basically saying, yo, my dude, send me those shares ASAP. And again, depending on the type of options contract and your position with it, they might also come up to you and say, yo, my dude, you're buying these shares for me, ha ha ha. And you can't really make any rebuttal because as an option seller, that is your part of the deal. So taking a deeper dive into the specific strategy itself being the covered call. Now, with the covered call, you are the one selling call contracts against the stocks that you already own. Now, dissecting this strategy's name, covered call. Covered refers to the fact that you already own stocks that you're going to do this strategy with. Calls are the types of option contracts itself that you are then going to be selling. Let's better illustrate this with an example, right? Let's say I own 100 shares of RBC, ticker symbol RY.TO, and I bought these at $100 per share. Now, for me, this is going to be a long-term play. Now, let's just say that this is going to be a long-term play for you, and you know that you're going to hold this for years. But as of right now, you don't think that it'll go any higher than $105 per share anytime soon. Alright, so I don't know if you've heard, but we're on Instagram. We're posting things on a daily basis. So if you're finding value from this episode and you want to learn more about different topics within the financial world, be sure that you follow us. azizz.finance or azizz.finance. Check us out on Instagram, send us a follow, and even send us a DM if you have any questions about anything from the episode or anything else on the page itself. I'll see you guys there. Because of this, you decide to sell a call option at $105 per share. This $105 per share is also known as the strike price. What does this mean? If you're wrong and RBC does touch 105 shares or more, the person on the other side of the deal, in this case, the call option buyer, they will snap their fingers and exercise the contract. If they exercise the contract,
you are literally forced to sell the shares to them at $105 per share. They won't do this at exactly the strike price from time to time. They might actually wait until it gets to 110, 115, or even $1 million if needed. Now, the reason why they might not do this right away as soon as it hits that 105 share price is usually one of two reasons. The first one is so that they could break even on the premium that they gave you. Now, a premium is an extra amount of money that the buyer of this contract paid you to buy the shares for $105. For this instance, let's just say that the person paid me 0.5 per share as a premium, essentially meaning that I got $50 just because I'm holding my end of the deal. The second reason that they're going to wait until the stock price is higher than that strike price of $105 is so that they can flip the stock as soon as they buy it off of you. Now, take this in. Since the other person bought the shares off you for $105 per share, but now it's at $110, boom, they can exercise it. They'll buy it off of you for $105 and then sell it in the open market as soon as they get the shares for $110. They'll basically be selling at that point for $5 of profit, or they might just keep holding the stocks, waiting for appreciation to hit even more. So the question comes to mind, should you use this strategy? Now, it depends because there are pros and cons to using this strategy, and I've actually highlighted these all in a video that I made on our YouTube channel about my covered call mistakes. I've linked this in the description below, so if you want to check it out for further context, please do, because it's probably one of the biggest risks associated with the strategy. But during my first days of trading options, I used this strategy for like every options trade that I did, and there were some nice notes that you could take from it, especially if you're considering doing this strategy. I think it's pretty important because I lost a lot of opportunities to make a lot of cash. So be sure to check it out so that you don't make the same mistakes that I did when I first started off using this strategy. Alright, Z community, that's pretty much it for today's episode. Now again, if you did find value from this, be sure that you're either following or subscribed to the podcast so that you're up to date with new episodes that are going to come your way. On top of that, if you feel like either your friend, your parents, your grandma, your grandpa are going to benefit from this episode or this overall pod, be sure you swing it their way, because at the end of the day, it could just be a nice little early Christmas gift or something. But nonetheless, guys, it's your boy Azizz Finance signing out. I'll see you guys on the next one.